Most people filing taxes this year have no idea that the IRS updated several rules that affect seniors specifically, not retirees in general. Not all Americans, people 65 and older, collecting Social Security, living on a fixed income, people exactly like you. And the changes touch three things that directly affect how much money you keep or how much you owe. Today, I am going to walk you through exactly what changed, who it affects, and what you need to do before you file. If you already filed, I will tell you what to do about that too. Let's get into it. The first thing you need to understand is the extra standard deduction for seniors. Most people know there is a standard deduction. It is the amount the IRS lets you subtract from your income before they calculate what you owe. For 2025 taxes, the standard deduction for a single filer is $15,000. But here's what a lot of seniors do not know. If you are 65 or older, the IRS gives you an additional deduction on top of that. For a single filer who is 65 or older, that extra amount is $2,000 in 2025. For a married couple where both spouses are 65 or older, it is $3,200 total extra, $1,600 per person. If only one spouse is 65 or older, it is $1,600 extra on top of the standard deduction. That is not a small number. That extra deduction directly reduces the income the IRS taxes you on. If you are in the 12% tax bracket, a $2,000 additional deduction saves you $240 in taxes. If you somehow missed claiming it in prior years, you may be able to amend your return and get that money back. I will explain how at the end. The point right now is this. If you or your tax preparer did not add the senior extra standard deduction to your return, you may have overpaid. And the IRS is not going to call you to fix it. That is your job, and today I am helping you do it. If this is new information to you, take a moment right now and like this video. It helps more seniors find this content, and that is the whole reason this channel exists. Now let's talk about Social Security and taxes, because this is where I see the most confusion and the most money left on the table, or worse, the most unexpected tax bills. Here's the simple truth. Some of your Social Security income may be taxable at the federal level, and how much depends on what the IRS calls your combined income. They sometimes call it provisional income. Do not let that term confuse you. It is just a calculation. You take your adjusted gross income, that is everything you earned from work, pensions, withdrawals from traditional IRAs or 401k accounts, interest, dividends, and you add to that any tax-exempt interest you received, like from municipal bonds. Then you add half of your annual Social Security benefit. Whatever that total number is, that is your combined income. Here is what the thresholds look like for 2025. If you are single and your combined income is below $25,000, none of your Social Security is taxable at the federal level. If your combined income is between $25,000 and $34,000, up to 50% of your Social Security may be taxable. If your combined income is above $34,000, up to 85% of your Social Security may be taxable. For married couples filing jointly, those thresholds are $32,000 for the lower range and $44,000 for the upper range. Notice I said up to. Now that is important. It does not mean all of it is taxed. It means that portion enters your taxable income calculation. And there are legal, legitimate ways to manage that combined income number to reduce how much of your Social Security gets taxed. I want to give you two specific strategies right now. The first strategy is being thoughtful about when you take IRA withdrawals. If you have a traditional IRA or a 401k, every dollar you withdraw counts as income and raises your combined income number, which can push more of your Social Security into taxable territory. One approach is to take larger withdrawals in years when your income is lower, for example, before you start collecting Social Security, and smaller withdrawals after. Another approach is to convert some of that money to a Roth IRA over time. Roth withdrawals do not count as income for this calculation. That is a longer-term strategy, and you should talk to a financial advisor before doing it, but it is worth knowing about. The second strategy is managing interest and dividend income. If you have money sitting in accounts generating significant interest, that interest counts toward your combined income. Some seniors find it useful to shift some savings into instruments that grow without generating annual taxable income. Again, this is worth a conversation with a professional who knows your full picture. Before we go further, I want to remind you to subscribe to this channel if you have not already. Hit the subscribe button and turn on notifications. Every week I cover topics exactly like this one. Real rules, real numbers, real steps you can take. You will not get this from the evening news. Now I want to address a question I hear often. Do you have to file a tax return at all if your only income is Social Security? The answer depends on your total income. The IRS has filing thresholds. For 2025, if you are single and 65 or older, you generally need to file if your gross income, not counting Social Security, exceeds $16,550. If you are married filing jointly and both spouses are 65 or older, that threshold is $30,750. But here is the catch. Even if you are below those thresholds, you may want to file anyway. Why? Because filing may be the only way to claim refundable tax credits you are entitled to. Credits that put real money in your pocket even if you owe zero taxes. The biggest one for seniors is the credit for the elderly or disabled. This is a federal tax credit specifically for people 65 and older or people under 65 who are retired on permanent disability. For a single filer, the maximum credit is $750. For married filing jointly where both qualify, it can be up to $1,125. Now, those amounts phase out based on income, so not everyone gets the full credit. But if your income is modest, this credit could mean the IRS sends you money back even if you owe nothing. You access it through Schedule R when you file your return. A lot of seniors have never heard of Schedule R. That is exactly why I make these videos. Write that down. Schedule R, credit for the elderly or disabled. If you are 65 or older and your income is on the lower end, check whether you qualify. The IRS website at irs.gov has an eligibility tool, or your tax preparer can check for you. Let's move on to something that surprises a lot of people. Estimated tax payments and the penalties the IRS can charge for not making them. If you have income that is not automatically withheld, think pension income, IRA withdrawals, investment income, or self-employment income from part-time work, the IRS expects you to pay taxes on that income throughout the year, not all at once when you file. The way you do that is through estimated quarterly tax payments. The due dates for 2025 estimated taxes are April 15th, June 16th, September 15th, and January 15th of 2026. If you have Social Security income and also collect a pension, and you are not having taxes withheld from either one, you may owe estimated taxes. If you underpay, the IRS can charge you an underpayment penalty. That penalty is currently based on the federal short-term interest rate plus 3 percentage points, and with interest rates higher than they were a few years ago, that penalty adds up faster than it used to. The good news is you can avoid the penalty if you meet what is called the safe harbor rule. There are two versions of this rule, and you only need to meet one of them. First, if you pay at least 100% of what you owed in taxes last year, or 110% if your income was above $150,000, you will not be penalized for underpaying this year, even if you end up owing more. Second, if you pay at least 90% of what you owe for the current year, you also avoid the penalty. If you get Social Security and you want a simple way to handle this, you can actually ask Social Security to withhold federal taxes directly from your monthly payment. You do this by filling out Form W-4V. It is a one-page form. You choose a withholding percentage, 7, 10, 12, or 22%, and Social Security withholds that amount from each check and sends it to the IRS for you. No quarterly payments, no tracking deadlines, no surprises in April. You can find Form W-4V at irs.gov or call the Social Security Administration at 1-8007-721-213 to request one by mail. Share this video with someone you know who is retired and unsure whether they are handling their taxes correctly. This is the kind of information that saves real money, and most people only find out about these rules after they have already paid a penalty they could have avoided. Now I want to talk about property tax and a common misunderstanding. Property taxes are set at the state and local level, not the federal level. The IRS does not directly fine you for property tax issues. That is your county or city. However, there is a federal connection worth knowing about. If you pay property taxes, you may be able to deduct them on your federal return. The current federal limit on the deduction for state and local taxes, which includes property taxes plus state income or sales taxes, is $10,000 per year for most filers. That cap has been in place since 2018. It is scheduled to change when certain provisions of current tax law expire, but as of 2025, that $10,000 cap still applies. Here is what matters for you right now. Many seniors are paying property taxes but not tracking those payments or not realizing they can deduct them if they itemize. And separately, most states have property tax relief programs specifically for seniors. These programs go by different names: homestead exemptions, senior freezes, circuit breaker credits, but they all do the same thing. They reduce or freeze your property tax bill if you are 65 or older and meet certain income limits. These are state programs, not federal, so they vary a lot by where you live. But nearly every state has something. To find out what is available in your state, call your county assessor's office or search your state name plus senior property tax exemption at your favorite search engine. You can also call the Elder Care Locator at 1-800-677-1116. They connect seniors to local resources and can point you toward property tax assistance in your area. Leave a comment below with your state, and I will do my best to point you toward the right program for where you live. That is what this community is for. Now let's talk about what to do if you realize you made an error on a past return, or if you are worried you missed a deduction you were entitled to. The IRS allows you to amend a tax return for up to 3 years after the original filing deadline. That means if you filed your 2022 taxes in April of 2023 and you realize you missed the senior extra standard deduction, you have until April of 2026 to go back and correct it. The form you use is called Form 1040-X. It is an amended return form. You fill it out showing what you originally reported and what the corrected numbers should be. If you overpaid because of the error, the IRS sends you a refund for the difference. The process is not instant. Amended returns currently take the IRS anywhere from 16 to 20 weeks to process, but if you are owed money, it is worth the wait. You can track the status of an amended return at irs.gov using a tool called Where's My Amended Return? You will need your Social Security number, date of birth, and zip code to check the status. If you are not comfortable doing this yourself, a certified public accountant or an enrolled agent can help. Enrolled agents are tax professionals who are licensed by the IRS specifically. They specialize in tax matters and are often less expensive than CPAs for straightforward amended returns. You can find an enrolled agent in your area at nae.org. That is the National Association of Enrolled Agents. Before I give you the complete action plan, I want to be transparent about something. Everything I have shared with you today is based on current federal tax rules as of 2025. Tax law can change, and your individual situation, your income sources, your state, your filing status may affect how these rules apply to you specifically. This video is educational information, not personal tax advice. Before you make changes to your tax filing or your financial strategy, please talk to a qualified tax professional who can review your complete picture. What I can tell you is that the rules I have described are real, they are accurate, and taking action on them could put meaningful money back in your pocket. Now let's bring everything together into a clear action plan you can follow this week. Step 1. Check whether you claim the senior extra standard deduction. If you are 65 or older and you filed a return for 2024, look at line 12 of your Form 1040. That line should reflect the higher standard deduction that applies to your age and filing status. If you are not sure what number should be there, the IRS has a standard deduction worksheet in the Form 1040 instructions at irs.gov, or call the IRS at 1-800-829-1040 and ask them to walk you through it. Step 2, calculate your combined income to understand whether your Social Security is taxable and how much. Add your adjusted gross income plus tax-exempt interest plus half your annual Social Security benefit. Compare that number to the thresholds I gave you, $25,000 and $34,000 for single filers, $32,000 and $44,000 for married filing jointly. If you are near or above those thresholds, this is a topic to discuss with a tax professional before you file or before you make major financial decisions next year. Step 3. Look into the credit for the elderly or disabled. If you are 65 or older and your income is modest, check your eligibility for this credit using the tool at irs.gov or ask your tax preparer about Schedule R. Even a $500 or $750 credit is worth claiming. Step 4. If you have untaxed income, pension, IRA withdrawals, investment income, make sure you are either having taxes withheld or making estimated quarterly payments. If you want the simplest solution, fill out Form W4V and have Social Security withhold a percentage from your monthly check. You can get that form at irs.gov or by calling 1-800-772-1213. Step 5. Contact your county assessor's office or call the Elder Care Locator at 1-800-677-1116 to find out what property tax relief programs exist in your state. This is a separate step from your federal taxes, but it can save you hundreds of dollars every year. Step 6. If you think you overpaid taxes in 2022, 2023, or 2024 because of a missed deduction or credit, look into filing Form 1040-X to amend those returns. You have until 3 years after the original filing deadline to claim a refund. That is your plan. 6 steps. Every one of them tied to real money. None of them require you to be a tax expert. They just require you to take action. If you watched this entire video, I want to say something directly to you. You did something today that most people do not do. You took time to learn how the rules actually work so you can make better decisions with your money. That matters. The government is not going to knock on your door and tell you about the extra deduction you qualify for. The IRS is not going to send you a letter explaining the credits you missed. This information exists, but it is on you to find it and act on it. And now you have it. Please subscribe to this channel if you have not already. Every video I make is focused on one thing: helping seniors keep more of their money and claim every benefit they have earned. Share this video with someone in your life who could use this information, and leave a comment below, whether it is a question, something from your own experience, or just letting me know which of these steps was most helpful to you. I read the comments, and I respond. Take care of yourself, take action on what you learned today, and I will see you in the next video.